Welcome to Investors Guide. Thank you so much for tuning in. This is a show that helps you find the perfect investment products in the market by looking at what suits your needs best. Now, it does seem like we've seen a sharp turnaround in our stock market. 700 points up on the Sensex in just one day. On the show today, we'll find out what this really means. Is this turnaround going to last? And how should you be reacting to the market right now? You can write to us. Email ID is at the bottom of your screen. Send in any question you might have about your money. Let's get straight to it. On the show this week, we'll find out if equity is turning around and if it should be your new best friend. In our product review, we look at the UTI Equity Fund and we'll find out where you should be investing your retirement corpus to safeguard your capital. Alright, it's time for me to bring in Kumar, the CEO of Value Research and our in-house mutual fund expert, who joins us on this show every week. Dhirendra, thank you so much for joining us on Investors Guide. Before we get started with the queries that our viewers have sent in during the week, I want to understand from you, how should we as retail investors be viewing this market right now? It turned around very sharply this week, largely on sentiment, was up 700 points in one day. Does this mean equity is back? Does it mean we should be increasing our SIPs, possibly getting excited about it? Or does your advice remain the same, that we should just continue our SIPs?
Yeah, I think so. Nothing changes except that, because last week when we were talking about it, when there was great nervousness around investments, then what I was saying will remain the same, except that, investors will not be as much worried today. I would still like to warn that, don't derive a lot of happiness or, derive pleasure from this surge in the market, because and it should not bother you, because if you are investing for next 10 years, 5 years, 15 years, then what happens today does not matter. In fact, it is injurious to you, because you will this month's installment or your SIP investment will be getting invested at a higher price. But yes, things do look a little cheerful, and you can derive your consolation from this. But be prepared for extreme volatility and stay on course. You don't have a control on the state of the economy, on the direction of the market in the short run, but you surely have a full say in where you want to be, how much time frame you have, and the course which you take to reach there, and not get distracted.
Alright, don't get distracted from your investments right now. Keep those SIPs running. Dhirendra, let's get straight to our portfolio question. Major Das Gupta has written in. He's a 35-year-old army officer. Between him and his wife, they have a monthly income of a little over 1 lakh rupees. He has two main goals. His 5-year-old daughter, he wants to plan for her education and her marriage. And he also wants to take a holiday with his family and possibly visit England in 2 or 3 years. Now, he sent us his entire list of investments. Luckily for him, his insurance is taken care of by the services. But he's investing about 50,000 rupees per annum in ULIPs. And I'm wondering if that's necessary at all. He also has 10,000 rupees going into his defense sector Provident Fund. Now, before we get to his mutual fund investments, for someone like him with his portfolio, does he need all of those extra insurance policies?
No, not at all. In fact, Army Group Insurance has been very liberal with it, and it's an exclusive insurance just for armed forces, just for army personnel, and that is quite liberal, and that has recently been revised as well. So that should be adequate. Otherwise, he should also consider, taking a term cover. Of course, army personnel are not covered for the generic term cover, but for normal conditions, he can still qualify as one. And there are 3-4 companies which provide the low-cost term insurance even to army personnel. But looking at his Provident Fund contribution, it is entirely into fixed income. Then money going into the, going into these endowment policies. That is nearly 45,000-50,000 rupees, and that I don't think is a very productive investment. Likewise, even his mutual fund investment is not a very organized portfolio, and he has about 60,000 rupees going into mutual fund annually. So I would say that he should actively work towards creating his emergency fund, and he has about 65,000 rupees there in a term deposit. So he should beef it up a bit, and he should do his own estimation. Beyond that, I think he should methodically get out of these endowment policies, and he can't do much about his PF, but all money going into endowment policy and the money going into mutual fund, he should actively, he should seriously consider our aggressive growth portfolio or growth portfolio, and because I find his portfolio quite haphazard, made up of some unrated funds, some balanced funds, and he can do without any of those.
Alright, so our growth portfolio is on your screen right now. Dhirendra, they're recommending that all of the money currently going into your mutual fund should be moved into our growth portfolio. You have plenty of time on your hands, so we can obviously put your portfolio back on track. Of course, he said you don't need any of those endowment policies that you have, so consider what you'll get back if you break those policies right now, plan it out systematically, and start moving that money as well into the same growth portfolio. Write back to us if you need anything else. Dhirendra, before we move on, he also wants 5 or 6 lakh rupees for his trip to England. This is obviously over the next 2 or 3 years. It's not money that should be going into his mutual fund. How would you like him to accumulate that money?
2 to 3 years time frame, I would think that, today term deposit rates are pretty good. And he should, he should build his, he should be little liberal with his, building up his, emergency plan. Emergency fund, and that should, he should provide for that. Do a recurring deposit for this particular objective.
Alright, so if you have any more questions about the advice you just received, feel free to write to us. Email ID is at the bottom of your screen. We have time to take a few more questions. Dhirendra, Surinder Sharaf is listening. He's retired now. He has 30 lakh rupees, which are his life savings. He wants to invest it so he can get a quarterly payout of interest to add to his pension income that he's already getting. He's also very particular about the fact that he wants to shield his capital from any losses. He wants to know where he should invest this money.
I would say that, of the 30 lakh rupees, 15 lakh can well go into, senior citizen savings scheme. Incidentally, that money which he will invest, there is a quarterly payout provision, the quarterly interest payment provision, and that is absolutely safe. And rest of the money, it is very important for him to ensure that the worth of his capital is protected, and that can be had only with investment in equity. And if he is very conservative, then I would say that, the remaining 15 lakh rupees, he should consider investing in a balanced fund, maybe a conservative balanced fund where the equity allocation is more diverse, is not taking chances. And another important thing is that, he should not be investing his money into a balanced fund at one go. Must spread that investment, 15 lakh rupees, over the next 18 months. The funds from our stable growth portfolio, I would say, a DST BlackRock balanced, or FT balanced, or Reliance regular savings balanced.
Alright, on your screen right now are 3 balanced funds that you can use to make that extra investment. Remember, you have to still consider the senior citizen savings scheme that will give you a regular payout. Let's move on to another question. Indu has written in from Orissa. He says he's a long-term investor, and he can invest about 6,000 rupees every month. He's also very positive about the fact that he believes that the index, the Sensex or the Nifty, will double in his time horizon of 7 years. He wants to know which index fund would be the most efficient for him to make that investment at this point.
If he is looking for the finest index fund, I would say the Goldman Sachs Nifty ETF is the best of lot, because it has the lowest expense ratio and it has zero tracking error. Being an ETF, it is able to replicate the index best and lowest expense ratio. But there is one issue, that he should be able to buy this. He has to buy this fund through a stockbroker, being an ETF.
Alright, so you need to have a demat account in order to invest in an ETF, but Dhirendra, they're giving you the name of the most efficient ETF in the market right now, and that's based on the tracking error and the charges on that fund. We're going to take a very quick break. Coming up on the other side, Dhirendra is going to stay with us. We'll talk about the UTI Equity Fund. We'll look at its performance over the last 1 year and see if it still deserves 5 stars, or if it's managed somehow to slip from its position. Don't go anywhere. Welcome back. You're watching Investors Guide in ET Now. Thank you so much for staying with us. Dhirendra Kumar is with us in our Delhi studio as well. It's time for our product review. And this week we're looking at the UTI Equity Fund. Avan is here as always to give us an introduction. Avan.
Thanks for that, Faye. Well, the fund in focus today is the UTI Equity Fund, formerly known as the UTI Master Gain Fund, that was launched in May 1992 as a closed-ended scheme. However, the fund turned open-ended in January 1997. After an exceptional run between 2002 and 2004, the fund faltered in the next 3-year cycle, holding 20% cash exposure in 2006, leading to its underperformance. Though the fund missed out on the initial part of the rally that started in March 2009, it made up with allocations in autos and increased its exposure to technology stocks. The fund was placed among the top 5 in its category in 2008, but it slipped to number 23 out of 70 funds. It has given returns of up to 12% since its inception and concentrates on sectors like technology, financials and energy. In the recent market volatility, the fund has managed to limit its fall to lower than the category average. Let's crunch some numbers to get you a better outlook on the fund's performance over the years. If you invested 1,000 rupees in this fund when it launched, you would have 6,131 rupees today. But is this a safe bet for you? Our experts have the answer. With that, it's back to you, Faith.
Alright, Avan, thank you so much for that introduction. There is a UTI Equity Fund, the large and mid-cap fund. When we reviewed this fund in May last year, you gave it 5 stars. It's not had a very good year since then. Would you still give it 5 stars? Do you think it might have slipped in terms of performance? It's somewhere in the middle of its category right now.
No, but I think that, this fund has still been able to deliver a decent return with far less, lower volatility. We are in a phase of a market where a fund which is able to manage the downside better, withstand a market decline better, is proving to be worthwhile, and this is what this fund has been able to deliver. So it is far less volatile than most other funds in its category. So and also the fund shows the same characters in terms of diversification, being conservative with its equity picks, and that shows in its relatively superior stability. So I would still call it an excellent fund.
Okay, still giving it 5 stars there for the UTI Equity Fund. There is a quick word for the viewers who invested in this fund who are probably a little nervous looking at the performance. How long do you think they should hang on and have faith about the performance of this fund? Do you believe it's going to catch up soon?
No, I don't think it has to do a lot of catch-up, because when I look at, the fund and relative to other funds in the category, looking at last 5 years, despite all this turbulence, the category is up about 7% and this is up about 11%. So that is 1.5 times more. If you are able to navigate through these lean times well, and if you retain a good portfolio, I think one should be hopeful of, making the most of in good times.
Alright, so making the most in good times, 5 stars there for the UTI Equity Fund. Remember, it was rated 5 stars last year in May as well. It's time to move on to our hold or sell segment. Well, Nilesh has written in, Virendra, he's 35 years old. He invests 23,000 rupees a month in mutual funds. He has a time horizon of 15 years. He wants to know if his portfolio is on track. Right on top on his list is the Axis Equity Fund. Should he continue that investment?
Yes, this is a relatively new fund, and if you would have, asked at the launch of this fund, I would have said no. But it has proved to be a very impressive fund and a very fairly rewarding fund in a very awkward market. So yes, he should continue investing in this.
The next on his list is the Franklin India Blue Chip Fund. It's a good fund with a strong performance. For a 15-year horizon, should he be investing in this fund?
Franklin India Blue Chip is an impressive large cap fund. But, for a 15-year time frame, I would suggest him to go for a fund which has a flexible mandate to, Blue Chip will be constrained to be in large caps only, whatever be the state of market. So, despite being a good fund, I don't think it's the appropriate fund for this time frame. Maybe, a Prima Plus will be a superior choice than Blue Chip.
Well, the next on his list is HDFC Top 200, Virendra. Will this also have the same problem that it's not flexible enough for the next 15 years?
HDFC Top 200 can well be flexible because, today it is tilting towards large cap, and it is tilting towards large cap also because, it has turned big, in terms of amount of money that has come into the fund. But I think this fund is proving to be disappointing and also constrained. And though I'm still hopeful that, when the market turns around, this fund will do well.
Virendra, you normally advise flexible funds. The next couple of funds on his portfolio, ICICI Prudential Discovery and UTI Opportunities, are these the flexible funds that we should normally have in a long-term portfolio?
When I look at ICICI Prudential Discovery, which is a value fund, it's a different strategy. And it's a good supplementary position to have. And likewise, UTI Opportunity, which can take big bets in few stocks. And of course, UTI Opportunity so far, despite having a flexibility, has been into large caps. But because it can take concentrated bets, it's a good bet to have for this time frame.
Last on his list is Axis Gold ETF, Virendra. Would you recommend that he has a gold ETF just for the punt on the price? Because he doesn't seem to have any particular goal for this particular investment.
Yes, if one is if one is optimistic about the market, if one is optimistic about the economy for a 15-year time frame, then it is just not wise to be having this 13% position in a gold ETF. So if you don't have a specific goal that you want to do some small saving which has to be exchanged in lieu of gold, real gold, physical gold at a future date, you can do without this.
Alright, so Dhirendra has reviewed your portfolio. It's on your screen right now. We have time for one last question. Saneet Singh Ranotra has written in, Dhirendra. He's 25 years old and he wants to be able to manage his finances efficiently and intelligently. He tells us he's just begun working. He wants to save a third of his monthly salary in fixed income instruments. And he wants to open a PPF account. But he wants to know what your thoughts are on other instruments that are similar that will allow him to save money with high returns and minimal capital risk. He tells us he's very bearish about his investment and he does not want to take any risk at all. What's your advice to someone who's 25 years old, saving a third of his salary, which is such a good idea, but doesn't want to take any risk?
He should carry on with his plan anyway, because if he is completely risk averse, it is important to save and it is important to put that money to work, however it's, even if the money is not working very hard. But I would say that, a small part of his money, he should try it out. He should consider a balanced fund, a small amount of money. If he is investing a third of his money, then maybe, 10% of his savings should find its way into balanced fund, and he should do it for 2-3 years. So I would say that earning is very important. Saving is more important than that. And putting that money to work in some form or the other is absolute, is a first step, and take the first step.
But even if he puts 10% in a balanced fund, I'm going to pull up on the screen the balanced funds that you recommended a little earlier on the show. What should he be doing with the remaining 90% of the money? Is a recurring deposit the best way to do it, or is there a more efficient and a more, a better investment out there for him?
90% of the money, a good part of that money, to the extent that it will get him the tax break, should find its way into PPS. Because there is an advantage. One is that he will be able to, tax save his money earned. So he should not be paying taxes to the extent that he can save, and PPF is that tax saving vehicle as well.
On your screen right now are the balance funds that Dhirendra has recommended. You can write those down one more time. Dhirendra, thank you so much for coming in on Investors Guide and answering all of our questions. We look forward to having you back again next week. If you have a question for Dhirendra, email ID is at the bottom of your screen. Coming up after the break, we'll find out where you should invest your retirement corpus to safeguard your capital. Stay tuned. Welcome back. You're watching Investors Guide in ET now. Thank you so much for staying with us. It's time for me to bring in Manoj Nagpal of Outlook Asia Capital, who joins us to answer some of the questions you sent in during the week. Well, Manoj, our first question comes in from Vinod. He's going to retire from the army next year and he'll receive a lump sum amount of 1.25 crore rupees as part of his pension. Now he says he's going to need 75 lakh rupees out of that money for his son's education and for his son's wedding. He wants to invest the remaining 50 lakh rupees in instruments that safeguard his capital and give him a tax rebate. Where should he invest this money, Manoj?
What I would suggest is that for your needs you should create 3 different buckets to meet your future goals. The first bucket is the children's need. Since you need around 75 lakhs after 3 to 5 years for your children's education and marriage, I would suggest 60 lakhs of the entire amount to be put into the first bucket. The second bucket should be an emergency bucket, which will be your needs if there is any shortfall in the first bucket, or there is any emergency that you face, or any short-term requirements, or some current income supplementation that is required. And the third bucket should be a long-term bucket, which should create further wealth to take care of your inflation and future needs of creating a kitty along as you grow on. Each of the buckets will have a different investment strategy. The first bucket, as the needs are fairly well defined in the next 3 years, we need the money of around 75 to 80 lakhs for your children's marriage and education. It should be a very conservative plan, and I would suggest not more than 10 to 15% in equities, and the balance into debt. Here, the equity portion, obviously I would suggest to go in for diversified equity mutual funds, large cap biased mutual funds. And the third bucket, since it's a long-term bucket and we visualize that the use of this should be around or creating wealth over 5 to 10 years, it will have a higher allocation of equity. But at the same point of time, considering that you will now be retired, we will need to balance it strongly by not overexposing to equity. So we would advise you not to have an exposure of more than 30 to 35% into equity in this bucket, in the balance 70% into debt. And again, the debt will be split across various asset classes. This should ideally take care of your needs in each of the three buckets and also help you reach your financial goals.
Our next question comes in from Suvajro, who's 26 years old. He's currently making 54,000 rupees every month. Now, he tells us he spends about 25,000 rupees, so he has plenty set aside. But let's take a look at his loans. He has an education loan that he's currently paying back. So he'll be paying it back again till 2018. He also has a two-wheeler loan. He has rent. He has to pay a credit card bill on an average of 12,000 rupees. Not very happy about that. He wants to know how he should sort out all of his finances. Manoj, would you like him to first start getting rid of those loans?
What I would advise is that since the loans, that is both an educational loan, which is at around 12.5%, and a vehicle loan, which depending on which bank you have taken, will be in the range of 11 to 14%. We need to create an accelerated repayment for these loans going along. Given your age of 26 years, we would recommend an aggressive plan for you within the range of 70 to 75% equity for this 20,000 that you save every month, and around the balance 25% should be going into debt. So out of your 20,000, 15,000 should go into an SIPs of mutual funds, in equity mutual funds. In the balance 5,000 that is there, we should start paying a part of that into the loans, and the 15,000 into equity mutual funds should be spread across various equity mutual funds and balanced mutual funds.
Last question on the show comes in from Nitesh Dubey. He tells us he can afford to invest 30,000 rupees a year right now, and he and his wife are planning to start a family. And he wants to know where he should invest that money for the child who's going to join his family in the future. Manoj, what would you like him to do?
There are two options you have. One, you can choose a child insurance plan from one of the insurance companies. That's a simpler composite product that's there, and it will also take care of the insurance of the entire plan. And the other option is that you segregate yourself and start investing into different various instruments yourself. Choosing an insurance plan, though, is simpler in nature but is costlier in terms of expenses, and hence I would advise you to take the second option. I would advise you to start putting 1,000 in a recurring fixed deposit of either a bank or a post office, which will take care of your needs going forward, and the balance 1,500 into a SIP of a large cap diversified mutual fund.
All right, Manoj, thank you so much for joining us. We've run out of time on Investors Guide this week. Remember, any question you have about your money, write to us. Email ID is on your screen. You can reach us through our Facebook page as well. You can reach me personally on Twitter. Tune in next week to catch Investors Guide. Thanks for watching.